If Smith Company issues 1,000 shares of $5 par common stock for $75,000, what is the journal entry? Well, we issue stock to get cash. We're going to credit common stock for the par amount. And then anything above that is going to be additional paid in capital common stock. Okay, so here it tells you the exact amount of cash you got. So we're going to debit that for $75,000. And then common stock, we're going to credit it for the par value times the number of shares. So 1,000 times 5 would be $5,000. Okay, so the remaining in excess of par is going to be your $70,000. So this is the cash you got, this is the common stock capital amount, and then this is everything over the par value. Alright, so treasury stock that had been purchased for $5,000 last month was reissued this month for $7,000. So we already bought it back, and now we're going to reissue all of it. So it doesn't ask for the entry where we purchased the treasury stock. That would have been a debit to treasury stock and a credit to cash, but it wants us to do the issue where we reissued this stock. Okay, so how much money did I get when I resold the stock? I got $7,000. Okay, so now I'm going to credit treasury stock for the amount that I originally bought it for, so the $5,000. So the amount over that is always going to go to additional paid in capital treasury stock. So that would be $2,000. Okay, in this problem, we're going to calculate the cumulative preferred dividend. Okay, so to find the amount that we should pay to preferred stockholders, we need to say 30,000 times 20 times 3%. And that is how much I want to pay them each year. So you should get 18,000. Let's go ahead and put in how much they were actually paid. So this is given to you. Year 1, it was 10,000. Year 2, it was 45,000, and in year 3, it was 100,000. Okay, so for year 1, I wanted to give them 18,000, but I only gave them 10, so they're only going to get what I'm able to give them, and common stockholders won't get any. And then the dividends per share for preferred, you're going to take the dividends they got divided by the number of shares of preferred, and it was 30,000. So you're going to do 10,000 divided by 30,000. So if you take 10,000 and divide it by 30,000, you're going to get 33 cents for dividends per share for preferred, and then common gets 0. Dividends in arrears, we were supposed to pay them 18. We only paid them 10,000, so we have $8,000 of dividends in arrears that we owe preferred stockholders. Okay, for year 2, I want to be able to pay the preferred the 18,000 plus the 8,000 in arrears. So do I have enough? I do, so I can pay preferred all that I owe them, so I don't have any in arrears for the next year. I'm paid up. So common gets what's left over. I paid out 45,000 total. Preferred got 26,000, so common gets 19,000. To calculate the dividend per share for a preferred, they got 26,000 divided by the total number of shares for preferred, which was 30,000. So they get 80 cents per share. For common, they got 19,000, and there are a total of 100,000 shares of common stock, so they get 19 cents per share. Okay, year 3, I'm all caught up. I have 100,000 dividends to give out, and preferred will get 18,000, and the rest will go to common. 100,000 minus 18,000 would be 82,000. So your dividends per share for preferred, you're going to take the amount that you got for preferred, 18,000, divided by the 30,000 shares of preferred. So they get 60 cents per share. And for common, they got $82,000. And there are 100,000 shares of common stock. So that leaves us with 82 cents per share. And then dividends and arrears, there were no dividends and arrears because we are completely caught up. So a quick recap of what we did here. For total dividends, I got those amounts from the paragraph. It tells you how much they paid each year. Okay, for pay to preferred, first I had to figure out how much I need to pay to preferred, or how much I want to pay to preferred. So we take the 30,000 shares times the $20 par times the 3%, and that will give us 18,000. So that is how much dividends we want to give to preferred. So if you need to write that number down somewhere, just so you know, that's how much we want to pay. Remember to calculate dividends, it's percent times par times number of shares. Then I needed to see if I have enough to give them. Well, in year 1 I didn't. I only had 10,000 that I could give them. So that left nothing for common. Dividends per share for preferred, I look at the amount that I paid to preferred and I divide by the number of preferred shares. So preferred was 10,000 divided by 30,000 shares. Common, 0 divided by 100,000 shares of preferred is 0. And I got the 100,000 up here. Hold on. Right here, 100,000 shares of common is given to you up here in this paragraph. And then how much is in arrears? Well, I wanted to pay them 18. I only could pay them 10, so that's how I got the 8,000 in arrears. Okay, here we're going to do an April 1st entry where 10,000 shares of $4 par common stock were issued at $21. So we're getting cash, and it's going to be the 10,000 times the $21. So that's going to be 210,000. And then you're always going to credit common stock for the par value. So $4 par value times 10 would be 40,000. Okay. And the rest is going to go into your paid-in capital account. And I'm going to put common stock so we know that that's a common stock account. So the difference here, you would do 210 minus 40, and that's the amount over par that you paid. Correction, that's the amount over par that was paid at when you issued the stock. This account also could be called additional paid-in capital. Either one of those would work. Okay, for the second one, I'm issuing preferred stock, so I'm going to get cash, and I got 5,000 shares, and it looks like they were issued at 105. So you would do 5,000 times 105. So that would be 525,000 for cash, and then you always put your stock on at the amount of shares times par. So $60 par times your 5,000 shares. So you would put in 60 times 5,000, just to show you how we're getting those numbers. Okay, and then the rest would be paid in capital in excess of par preferred stock, or additional paid in capital. You could use that one. And it's just the difference or the amount above par that they paid you. Okay, so next we're going to do dividends, the important dates. With a cash dividend of $60,000 on a corporation's common stock, the dates are January 15th, February 15th, and March 15th. Journalize the entries required on each date. Okay, so on the first date, I'm going to do dividend and dividends payable. We're going to set up the liability for $60,000. On February 15th, there is no journal entry for the date of record. All we do here is figure out who we need to pay the dividends to. Okay, and then on the date of payment, we get rid of the liability and we pay off the cash of $60,000. Okay, so when we issue a stock dividend, we're going to debit dividend, credit common stock dividends distributable, and anything above the amount is additional paid in capital. So if we take $100,000 and do 5%, that's going to tell me the amount of stock dividends, the amount of stock that I'm issuing. So 100,000, and then you're going to do times 0.05. So I'm issuing 5,000 shares of stock. So for dividend, you take your 5,000 shares times your market value of $132. And that's going to get you to $660,000. But you can only credit it for the par value, which is the 5,000 times the $50 par, so that's $250,000. So the rest would go into additional paid in capital, the difference. Okay, there's no entry here. This is just going to tell us who's going to get the stock shares. So when I issue the stock, I'm going to debit common stock dividends distributable, take it out of that, and actually issue the common stock, and it's already at par value. And so this is how you issue a stock dividend. Notice that it does have elements of stock because you are issuing stock. You have common stock and additional paid in capital. And this is the end of the sheet, so just let me know if you have any questions.